Hi CS students, let's revise chapter 2 risk management in CA final AFM. So there is one practical question in study material. So before going to it, we'll just see what is this value at risk. So value at risk is the measure of risk of investment. And okay, before going to the practical question, we'll see the example in our study material that gives a base idea. It's in page number 2.6. So the example is like, so ideally in VAR, value at risk, we'll find out the risk of an investment. In the given example, they mention suppose you hold worth 2 crore shares of X Limited, whose market price standard deviation is 2% per day, assuming 252 trading days a year. Determine maximum loss level over the period of 1 trading day and 10 trading days with 99% confidence level. Now, before diving into the question, we'll just see what is confidence level and then what is standard deviation. Standard deviation is, as we aware, it is the volatility of loss. Let's say in this case 2% per day means for 2 crores into 2%, which is 4 lakhs, my loss will either go up, either I'll get a loss of 4 lakh or I'll get a profit of 4 lakh. That is standard deviation. And confidence level is like the probability that losses will not exceed the given threshold. So in the given example, they have mentioned as 99% confidence level. That means that I'm 99% confidence that my loss will not go more than the 2% of standard deviation. Okay, this is the base idea. So in this case, they are asking what is the maximum loss for 1 trading day and then 10 trading days. So first we'll go with 1 trading day. So there is something called this Z score, which will give us the multiple for the given standard deviation. So in our case, since the confidence level is 99%, so we have to refer that normal distribution table to get this value. Usually 99% confidence level and 95% confidence level is used in the questions. So for 99%, the Z score will be 2.33. We can use it as a standard base. So value at risk for 1 day will be Z score into standard deviation for 1 day. So as we previously calculated, standard deviation for 1 day will be 2 crores into 2%, wherein 4 lakh I might get a loss, which we will multiply with 2.33 times. So which is the Z score for 99% confidence level. So our loss will not exceed 9,32,000 in this case, but there is 1% possibility that it might go more than 9,32,000. That is the ideology here. So for 99% confidence level, my loss will not go more than 9,32,000 per day. That is how we calculate value at risk. Now in the question they have asked for 10 trading days also. So VAR for 10 days will be calculated by VAR for 1 day into root of days, number of days, time. So in our case, since it is 10 days, so we'll calculate root 10, which is coming around 3.16 into 9,32,000, which will be 29 lakh. We might have a normal doubt why we are not multiplying into 10. Like the loss is 9,32,000 and why we are not multiplying it with 10. This is because risk does not scale linearly with time. It is unrealistic. Let's say 9,32,000 into 10 if I do, it will come around 93 lakh 20,000, which is not realistic. That is because 1 day I might earn profit and 1 day I might earn loss. So my assumption is that my loss will not exceed 9,32,000 per day. But let's say first day I'm getting a loss of 9,32,000 and second day I'm getting a profit of 5 lakh or 10 lakh and third day I'm getting a loss. then fourth day loss or profit, whatever. So it fluctuates, it's not linear. My assumption should be realistic, right? So some gains cancel out the losses because of fluctuations. That is why we are using the root of time. Okay, now coming back to our practical question in our book. So consider a portfolio consisting of 2 lakh investment in share XYZ and a 2 lakh investment in share ABC. Daily standard deviation of both shares is 1% and that the coefficient of correlation between them is 0.3. You are required to determine the 10-day 99% value at risk for the portfolio. Now we have a standard formula for this is not a case as the same example, because in the example we just dealt with only one investment, but here we are dealing with two investment in different scenarios. So it's a portfolio wherein I have invested 2 crores in XYZ and 2 crores in ABC, and my standard deviation is 1%. Coefficient of correlation is 0.3. This coefficient of correlation is like, um, if if I'm getting a profit of, if let's say if my coefficient of correlation is 1, then if I invest 2 crore in XYZ and I'm getting a profit of 20,000, then in ABC also I will get the same 20,000. If my coefficient of correlation is -1, then if I get profit in XYZ, I'll get loss in ABC. So it's like how the both investments are related. So in our case, since they have given 0.3, that is how XYZ investment and ABC ka returns are related. So going further, we have to first calculate standard deviation of the portfolio. Since standard deviation of individual investments and standard deviation of portfolio are different, uh, so there is a specific formula wherein we have to calculate the standard deviation of portfolio. It is our basic mathematical formula. I'll explain in detail if you guys require a separate explanation. As of now, we'll go with the basic logic for remembering the formula. So it's like our a plus b the whole square, a square plus b square plus 2ab. Here, since they are correlated, we have to multiply it with the correlation. For this, I can explain you in detail in a separate video. Please comment below. Going further, as we have the investments, we'll just square like apply in this formula, and we'll get a standard deviation for portfolio. Sorry, variance for the portfolio. And since standard deviation is root of variance, we'll get the standard deviation as 3.22 lakhs. So what is this 3.22 lakhs? As previously explained, standard deviation is the volatility of loss. So in our case, I have invested 2 crores in XYZ and 2 crores in ABC. My loss can maximum go up to 3.22 lakhs. Now coming up to our value at risk, I'll again multiply with the Z score 2.33 into 3.22, so which is coming around 7 lakh 50,000. And if I multiply with the root 10, I'll get for 10 days, which is coming up to 23 lakh 72,000. Thank you.